Welcome to our channel. Today we're diving into the dynamic world of the housing market. From the factors that drive booms and busts to the roles of various participants, understanding the housing market is crucial for both individuals and economies. Let's explore the intricacies of this essential aspect of life. To truly grasp the complexities of the housing market, it's helpful to look at its history. The concept of owning property dates back centuries, with land ownership being a symbol of wealth and status. However, the modern housing market as we know it began to take shape in the 20th century with the advent of mortgage lending and suburban development. In the post-World War II era, many countries experienced a housing boom. Governments provided incentives for home ownership, and the construction of new homes surged. This period saw the rise of suburban neighborhoods driven by an increasing desire for home ownership and the availability of affordable mortgages. However, the housing market has also faced significant downturns. The most notable in recent history is the 2008 financial crisis, which was precipitated by the collapse of the housing bubble. Lax lending standards and speculative investments led to a dramatic increase in home prices, followed by a severe market correction. Understanding these historical trends helps us see the cyclical nature of the housing market, characterized by periods of growth and decline. With this context in mind, we can better appreciate the factors that shape the housing market today. Now, let's delve into the foundation of housing markets to see what really makes them tick. Before diving into the players in the housing market, let's first understand the foundation of housing markets themselves. At its core, a housing market is where homes are bought, sold, and rented. This market is influenced by a myriad of factors including economic conditions, interest rates, and government policies. Economic conditions such as employment rates and wage levels directly affect people's ability to buy or rent homes. Interest rates, determined by central banks, influence the cost of borrowing money for mortgages. Lower interest rates generally make borrowing cheaper, boosting housing demand. Conversely, higher rates can dampen demand as borrowing becomes more expensive. Government policies also play a pivotal role. These can include tax incentives for home buyers, regulations on lending practices, and zoning laws that determine where new homes can be built. Understanding these foundational elements is crucial to grasping the bigger picture of the housing market. Now, with this foundation set, let's meet the key players who make the housing market tick. The housing market is a complex ecosystem with a variety of key participants. First, we have buyers, individuals or families looking to purchase a home for living or investment purposes. Then there are sellers, current homeowners aiming to sell their property for reasons like upsizing, downsizing, or moving. Lenders are also crucial. Financial institutions that offer mortgages to finance home purchases. Builders play a significant role too. Companies that construct new homes to meet market demand. Real estate agents are essential. Professionals who help facilitate transactions between buyers and sellers. Lastly, government agencies. They regulate the industry, influence mortgage availability, and sometimes participate directly through affordable housing programs. The dynamics of supply and demand are the core determinants of housing prices. Let's break it down. Increased demand is driven by factors such as population growth, a robust economy with rising incomes, and low mortgage rates, which can fuel demand and push prices upwards. Decreased supply, on the other hand, can result from limited land availability for development, stringent construction regulations, or the reluctance of existing homeowners to sell, which can restrict supply and cause prices to rise. A housing boom is marked by rising demand and limited supply, causing a surge in prices. Here's how it plays out. First, there's a buying frenzy. A strong economic climate fosters optimism, and low mortgage rates lure buyers into the market, often resulting in bidding wars and homes selling above asking price. Next, increased investment. The potential for high returns draws investors to the market, further driving up demand. And finally, a construction boom. The rise in prices motivates builders to ramp up construction activity, eventually boosting supply. The boom cycle, however, is not sustainable. Eventually, a correction becomes inevitable, leading to a housing bust. Economic downturns, recessions, unemployment, and declining incomes can significantly reduce demand. Buyers become hesitant, and existing homeowners may struggle to afford their mortgages. As economic conditions worsen, lenders may tighten credit standards, making it harder to obtain mortgages. When homeowners find themselves unable to keep up with mortgage payments, they risk losing their homes to foreclosure. Falling prices create a sense of uncertainty, discouraging potential buyers and leading to a downward spiral in price. The fallout from a housing market bust can be extensive, affecting individuals, financial institutions, and the broader economy. First, negative equity. Homeowners may find themselves underwater, owing more on their mortgages than the market value of their property. Next, financial institutions' strained foreclosures often result in losses for banks and other lenders who hold the mortgages. And finally, economic downturn. A housing market crash can deepen economic downturns as the housing sector is closely linked with other parts of the economy. Governments have the power to alleviate the adverse impacts of housing market fluctuations through strategic policies. For example, monetary policy central banks can adjust interest rates to steer the housing market. Furthermore, regulation enforcing stricter lending criteria or controlling speculative investments in housing can curb excessive risk-taking. For individuals navigating the housing market, here are some strategies to consider. Firstly, market research. Stay informed about market trends and conditions in your area. Secondly, financial preparedness. Ensure you have a strong financial foundation before buying a home. This includes saving for a down payment and having a stable income. Lastly, professional guidance. Work with experienced real estate agents and financial advisors to make informed decisions. Grasping the dynamics of the housing market is essential for making smart choices, whether you're buying, selling, or investing. By staying updated and consulting experts, you can confidently navigate the complexities of the housing market. Special thanks to Wikipedia for providing a structure of knowledge. Thank you for watching our channel. If you found this video helpful, please like, subscribe, and hit the notification bell for more insightful content. Stay tuned for our next video.